Welcome back to Smart Stock Sam, the channel where we call the moves before the market does. And today, I have to say, it feels good to be right. On last weekend, right here on this channel, we flagged Poet Technologies as one of the most explosive setups in the entire AI space. We talked about the structural mechanics, the institutional accumulation, and the catalysts that most analysts were completely ignoring. And then, May happened. The stock went absolutely vertical. If you were watching and had the discipline to act on that thesis, you are sitting on gains that most people only dream about. This is exactly what Smart Stock Sam is built for, finding the signal inside the noise before Wall Street catches on. So today, we are going deep. This is your full autopsy on one of the most polarizing and now most validated names in the AI infrastructure space, the April bloodbath that almost buried this company, the miracle rally in May that sent it screaming to all-time highs, the three structural pillars that powered that recovery, the terrifying valuation metrics that should give every investor pause, and the legal time bomb sitting on the June calendar that could either clear the path forward or blow up the entire thesis. We close out with a precise trading plan: entry, target, and hard stop. Stay with me. You do not want to miss what is coming. Now, to understand why May was so explosive, we have to rewind and appreciate the pivot Poet Technologies is currently attempting, moving from a development stage research firm into a high-volume commercial manufacturer. For years, Poet was all potential and no production. The tech was brilliant on paper, but revenue was essentially invisible. Then the balance sheet shifted. Poet built a cash reserve of $430 million. For a small-cap technology company, that is not just a cushion. That is an absolute war chest. It kills the bankruptcy narrative stone dead and gives the company the oxygen to scale manufacturing in Malaysia. That cash reserve is precisely why sophisticated institutional investors stayed patient while retail panicked. The core technology is called the Electrical Optical Interposer, the EOI. Think of it as the optical nervous system for artificial intelligence infrastructure. In a world where AI compute is scaling aggressively every year, the biggest bottleneck is no longer just processing power. It is bandwidth, moving data fast enough without the heat and latency limitations of copper wire. Poet's EOI is engineered to solve that problem at scale, but as thousands of investors discovered in late April, being fundamentally sound provides zero protection against extreme volatility. And that April volatility, it was not a dip, it was a full liquidation event. Look at that chart from April 27th. The stock opened around $15.10, and then it collapsed. Within hours, it was trading below $8. That is a 47.35% collapse in a single trading session. The catalyst? Reports emerged that Marvell Semiconductor, a major player in the space, had canceled purchase orders from Poet, apparently following a confidentiality breach by Poet's own chief financial officer. The market's reaction was swift, brutal, and completely unforgiving. In one afternoon, nearly half the market cap evaporated. Now here is the question I want you to really sit with. Could anyone have predicted that a stock would lose nearly half its value in a single afternoon, only to more than double and hit all-time highs just 3 weeks later? Realistically, almost nobody. That is the kind of move that breaks risk models, wipes out stop losses, and sends even experienced traders running for cover. But that is exactly what happened with Poet Technologies in May. On May 14th, the stock launched in pre-market trading and obliterated the $15 level before the opening bell. By the time intraday trading peaked, the stock had screamed all the way to $20.81. That is a 43% gain in a single session. If you had the courage and the conviction to buy into the fear in April, you would be sitting on gains exceeding 150% in less than 30 days. So, was this a dead cat bounce? Was it pure retail mania? Or is something structurally and fundamentally different now? 3 things changed, and all 3 of them matter. First, management strengthening. On May 11th, POET announced the appointment of Dr. Sandeep Kumar as Chief Operating Officer. This is not a ceremonial hire. Dr. Kumar brings 18 years of operational experience from Silicon Labs, a company renowned for precision engineering and high-volume production. You do not recruit someone with that pedigree and that background unless you are dead serious about scaling manufacturing. This hire sent a clear signal to the institutional community that POET is not playing games about its production timeline. Second, the commercial lifeline. The Lumilens agreement completely transformed the narrative around POET's commercial viability. This is not a letter of intent or a memorandum of understanding. This is a landmark commercial deal that, in the market's eyes, directly replaced the Marvel revenue that was lost during the April crisis. We will get into the full magnitude of this deal in a moment. Third, market mechanics. Between the launch of a new 2x leveraged ETF tied to POET's performance and intense options market activity, the stock was structurally primed for a mechanical squeeze. When these three pillars aligned simultaneously in May, the result was the rally we all watched unfold. Now let us talk about the deal that saved the company, the Lumilens agreement. The headline number is a $50 million initial order. That alone is significant for a company of POET's size. But the real story is the total commercial framework, which carries the potential to exceed $500 million over 5 years. For a company scrambling to prove commercial viability just 30 days earlier, this framework permanently alters how analysts must model POET's revenue trajectory. This is not merely a customer relationship. It is a stamp of approval from the AI infrastructure industry. It signals to every data center operator and hyperscaler watching from the sidelines that POET's EOI technology is mission-critical for the next generation of compute architecture. But here is where Smart Stock Sam is different from the hype channels. We do not just tell you the good news and let the emotions do the rest. We look at the full picture, including the numbers that should make you genuinely uncomfortable. Q1 of 2026 delivered revenue of approximately $503,000. Year over year, that is growth exceeding 200%, which sounds impressive until you realize the baseline was essentially nothing. They carry $430 million in cash, which is genuinely remarkable, but they burned through $12.3 million in operating losses in just 3 months. Wages have roughly doubled, stock-based compensation is surging, and the metric that should stop every rational investor cold is the price-to-sales ratio, 900 times revenue. A $2 billion market capitalization, supported by approximately $1.1 million in annual revenue. In virtually any other sector on the planet, that number would be considered completely irrational. In the world of AI infrastructure, bulls call it forward-looking. But what it really means is this: there is zero margin for error. Every quarter, every announcement, every contract renewal carries existential weight for the valuation. Given those metrics, you might expect sophisticated institutional money to be heading quietly for the exit. The data says exactly the opposite. 106 institutional owners currently hold over 11 million shares. Most notably, Raymond James Financial recently increased its position by nearly 55%, pushing their holding above 1 million shares. These are not momentum chasers. These are institutional desks with research teams, risk committees, and long investment horizons. They are not looking at the 900 times price-to-sales ratio the way a value screen does. They are looking at operational alignment. Consider the compensation structure of new COO Dr. Sandeep Kumar. He was granted over 410,000 restricted stock units, with his entire package explicitly tied to production milestones in Malaysia over the next 3 years. When insiders and institutional money are aligned on that specific 3-year window, it signals they are not playing the quarterly earnings game. They are playing a long-game thesis around POET becoming a critical supplier in the global AI supply chain. But, and this is critically important, none of this institutional confidence matters if the company gets derailed by the legal overhang sitting directly ahead on the calendar. POET is currently facing multiple federal class action lawsuits from firms including Pomerantz and Rosen. The core allegation that POET failed to properly disclose the implications of its passive foreign investment company tax status, known as PFIC, which could create significant and unexpected tax consequences for American investors. Additionally, there is ongoing legal exposure tied to the public comments made by former CFO Thomas Mika, which allegedly contributed directly to the loss of the Marvel relationship. The company's primary countermeasure is a proposed redomicile, essentially relocating its corporate legal home to the United States, which would directly address both the PFIC tax complications and certain structural barriers to institutional adoption. Here is your critical date. June 26th is the shareholder vote on that redomicile proposal, and June 29th is the legal filing deadline for the class action proceedings. If you are holding POET shares today, those 2 dates on the June calendar are just as important as any earnings release. If the redomicile vote fails, the legal overhang does not fade, it solidifies, and a solidified legal overhang sitting on top of a 900 times price-to-sales ratio at an RSI reading of 81.8, that is a combination that could get very ugly very quickly. Let us look at the technical picture because the chart is sending a very clear message right now. The 14-period Relative Strength Index, the RSI, is sitting at 81.8. In plain English, this stock is extremely overbought. When RSI climbs into the 80s, it is a historically reliable signal that mean reversion is near. The MACD is showing a golden cross, confirming the intensity of bullish momentum, but also confirming just how extended that momentum has become. The rubber band is stretched as far as it will go. The tension between the structural bull case and the mechanical need for mean reversion is building with every session. Now let us go beneath the surface, because the most fascinating part of this story is not on the public charts. The publicly reported short interest sits at 9.6%, not alarming on its own. But look at the dark pool data. The off-exchange short volume ratio sits at a staggering 50.73%. A massive submerged mass of short sellers is currently underwater, sitting on losing positions. Combine that with a put-to-call ratio of 0.56, and you have the mechanical ingredients for a gamma squeeze. Market makers who sold call options are forced to buy the underlying stock to hedge their exposure as the price rises. That buying pressure drives the price higher, which forces more hedging, which drives the price higher still. It is a feedback loop, a parabolic run fueled not just by retail enthusiasm, but by mechanical necessity baked into the options market structure. Here is something worth noting. The official analyst community has not caught up. Legacy price targets sit between $7 and $8, and the stock trades at roughly triple those levels. Those models predate the Lumilens framework, Dr. Kumar's appointment, and the gamma mechanics. The community-derived narrative fair value sits near $17.37. When institutional desks revise their models and issue targets in the $20+ range, that wave of upgrades could fuel the next meaningful leg of this rally. Now let us talk about how to actually trade this without getting destroyed. The entry zone we are watching is between $17.50 and $18.50. That is the zone where the stock pulls back from overbought RSI levels toward the key Fibonacci pivot support area. The discipline here is non-negotiable. Do not chase green candles at $21. Wait for the retest of support. The primary bullish target, supported by continued gamma mechanics and anticipated analyst revisions, sits in the range of $22.50 to $25. That is the 25 is in play thesis, and the structural case for it is real. But you must have a safety net. The hard stop-loss level is below $14.50. Why that specific level? Because a confirmed break below $14.50 signals that the stock is sliding back toward the crash range established in April. Below that level, the bull thesis is structurally compromised, and holding through it is not conviction. It is denial. Think about the price architecture in layers. The immediate resistance ceiling is the intraday high of $20.81, the recent 52-week high. Above that sits the after-hours peak of $22.89. A clean break above $22.89 on volume opens the door to blue sky territory. On the downside, the current pivot level is $17.39. Hold that, and the bulls maintain structural control. Beneath it, the 20-day moving average at $15.71 and the 50-day moving average at $12.85 represent the deeper defensive lines. As long as those averages hold, the Golden Cross narrative stays intact. And underneath all the chart patterns and the options mechanics and the legal timelines is a technology that genuinely matters. POET's electrical-optical interposer is the linking tissue between AI compute, next-generation data centers, and high-speed memory architecture. The Lumilens deal is not just a revenue event. It is confirmation from the industry that this technology is ready, it is scalable, and it is needed right now. If the Malaysia manufacturing ramp executes according to plan, POET is not a meme stock. It is infrastructure. It is the optical nervous system of the AI era. So here is the bottom line. POET Technologies has navigated from a high-risk speculative story into a fundamentally validated artificial intelligence infrastructure company. The $430 million cash position ensures survival through the scaling phase. The Lumilens framework provides a credible revenue anchor. Institutional accumulation signals long-term conviction. But the June 26th Redomicile vote and the June 29th legal deadline are genuine binary risks. If either goes wrong against a backdrop of an RSI in the 80s and a 900 times price-to-sales ratio, the correction could be swift and severe. The verdict from Smart Stock Sam? Strong buy on disciplined pullbacks into the 1750 to 1850 range, with a hard stop below 1450 and a primary target of $22.50 to $25. Do not chase parabolic momentum. Let the trade come to you. Before we wrap up, a quick but important note. Nothing you have heard in this video is financial advice. I am not a licensed financial advisor. Everything discussed here is for educational and informational purposes only. Past performance, including any predictions made on this channel, does not guarantee future results. Always do your own due diligence, consult a qualified financial professional, and never invest more than you can afford to lose. Trading individual stocks, especially small cap and volatile names like POET, carries significant risk of total loss. You have been warned. Now invest wisely. And on that note, here is the question I want you to answer in the comments right now. If the June 26th Redomicile vote passes cleanly and the legal overhang clears, do you think POET reaches $25 before the end of the summer, or does the valuation become the ceiling? Drop your answer below, because this community produces some of the sharpest thinking on YouTube, and I genuinely want to hear where you stand. If this breakdown gave you clarity, gave you confidence, or just saved you from making an emotional decision, smash that like button right now. It takes 1 second, and it tells YouTube to push this analysis to more investors who need it. If you are not yet subscribed to Smart Stock Sam, hit subscribe and turn on notifications, because when the next big setup emerges, I am not waiting for the mainstream to catch on. And if you want to support what we are building here, consider sending a super thanks using YouTube's support feature. Every contribution goes directly back into the research and the tools that make content like this possible. Stay disciplined, stay curious, and I will see you at the next breakout.